Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. This video on private equity investing is part of a series that we call Alternative Investing Reality Check. Many investors believe that alternatives are a good way to raise returns and the diversification of their investment portfolios. As we show in this Reality Check series, on average, alternatives have not achieved those objectives, at least for the past decade. We believe the best emphasis for investors is on smart allocation and low implementation costs. Private equity is a fast-growing category of alternative investing. As this chart shows, there is more than $3 trillion invested in U.S. private equity, which is triple the amount that was invested 8 years ago. The main reason investors are attracted to private equity are there's a greater opportunity set. The vast majority of companies are private companies. A private equity owner has much greater influence on the operations and capital structure of the companies in their portfolio than a public equity investor typically has. There's an expectation among investors that private equity inherently has an illiquidity premium, that private investing will have a higher return on average than public equity. And there's also a perception of a diversification benefit. Despite these potential advantages, in recent years, private equity has not lived up to its promise. The performance of private equity can be challenging to decipher. The method used to calculate returns is the internal rate of return. That's a very gameable metric, which often is misleading and typically exaggerates true performance. One important source of performance distortion has been the increasing use of subscription lines of credit to manage IRRs. Based on returns as reported, there's a surface appearance that private equity returns have exceeded public stock market indices. However, private equity holdings have different sector allocations, leverage, risk, and market capitalization than the public equity benchmarks. Most studies that we've seen of private equity performance, which make proper adjustments for these differences, have found that private equity firms on average have generated net of fee returns which are no better than could have been achieved with similar investments in public equity. This chart shows in blue the 10-year annualized return through 2023 for private equity from 3 different sources, and then in green 3 public market benchmarks. All 3 sources of private equity returns show a higher return than the S&P 500. So a casual observer might think the case is made that private equity returns are better than public equity. However, suppose in the last 10 years you invested in the S&P 500 with the same sector weight and the same leverage as private equity. You would have obtained a 17% return, which is higher than these reported private equity returns. PitchBook recently did an interesting study which showed that if one selected stocks based on the criteria which private equity firms use in take private transactions, then the return over the last decade would have been 19.2% per year. So well better than the average return of private equity. One challenge to net of fee outcomes of private equity are the fees. Private equity firms typically charge a management fee of 2% of underlying assets, plus a carried interest, 20% of the profits. And if you invest via a fund of funds, there's another layer of fees, which might be 1% of assets and another 10% of profits. This chart illustrates how the return of the S&P 500 would have been impacted if 2 and 20 fees were applied, and if both 2 and 20 and 1 and 10 fees were applied. An investor in the S&P 500 who paid both layers of fees on their return would have ended up paying most of the return, 60% of the return away in fees. It can often be the case that even when a private equity manager has skill, the fees paid to the manager offset all the benefit of that skill, and then the limited partner is left with an investment performance which could have been better if the same thing had been tried in public equity. Another current issue for private equity investors is the escalating mismatch between the money going in and the money coming back out. There's been a pileup at the exit window, and this has become a source of strain for private equity firms and their investors. As the chart here indicates, private equity exits via initial public offerings tend to be higher in years like 2021, when public equity is doing well. But we can see the nice rebound in stock prices which occurred in 2023 did not lead to a corresponding rebound in buyout-backed IPOs. There are about 20,000 US companies backed by private equity, and yet there are only 1,000 exits of any kind in 2023. And in fact, 2023 had the lowest proportion of assets distributed back to investors of any year since the global financial crisis year of 2009. One might ask, if exits are hard to come by when the economy is strong and the stock market is at record highs, then what might happen to exits should conditions become worse? Many investors also believe that private equity provides low volatility and a diversification benefit. This is an illusion based upon the way that private equity returns are reported with smoothing and a lag. In reality, private equity investments tend to be in smaller companies than in the stock market indices and tend to have more leverage, and as a consequence then they're riskier than the public equity benchmarks are. Some investors, like the large university endowments, have managed to succeed as private equity investors since there's a wide dispersion of outcomes. The investors with the best chance to benefit from private equity investing are those who have very experienced specialists who know the funds and can identify the best funds and are perceived as being a desirable limited partner. That may not describe you or the way that you are sourcing your private equity. David Swensen, who was a truly masterful investor in private equity as chief investment officer of the Yale University Endowment, once said, the quote here, "In the absence of truly superior fund selection skills or extraordinary luck, investors should stay far, far away from private equity investments." To summarize this video, the returns as reported by private equity firms can be misleading. Even as reported, private equity returns don't look better than comparable public equity strategies. The high fee burden, particularly if you invest via funds of funds, detracts from private equity outcomes. There, at present, are severe liquidity strains in the private equity ecosystem, and we believe success as a private equity investor requires organizational resources that tend to not be available to individuals and their advisors. Thank you for listening. You may find more information about alternatives investing at our website, atlasca.com. You may also email us at info@atlasca.com. Thank you.